Hello and welcome to this January 2025 investment outlook video from Fidelity. I'm Ed Monk and I'm joined today by the Outlook's author Tom Stevenson to answer your questions about where Tom thinks markets are now and where they may be headed in the months ahead. Now, Tom, as always, we've asked Fidelity investors to submit their questions to you in advance, and I'm pleased to say that a great many have done just that. I'll add here that these are Tom's view of the market. It is not investment advice, but should be seen only as guidance. That said, Tom, let's put some of those questions to you now. And the first one is this. It is said at the moment that North America is overvalued and expensive, whilst the UK is cheap. But what would be the advantage of buying UK funds, even if they are cheap, when the UK market is likely to fall if the North American market crashes? It's a good question.
It is a good question. And well, there are a few different parts in that question. I mean, first of all, the point about the valuation of the US stock market is true, or at the very least, parts of the US market are very highly valued. And that's an important distinction because I think that not all of the US market is expensive. And I actually addressed this point in my fund picks for the year because I've actually selected a fund which addresses a part of the market, the smaller companies part of the market, which actually is much more cheaply valued than the big growth high tech companies at the other end, which are highly valued. So yes, the US is partly highly valued. The UK is much cheaper, as the questioner points out. It's probably in terms of the usual measurement of this, the price to the earnings ratio, it's about half as expensive as the US market at the moment. But I mean, the question makes a very good point that the global markets are dominated to a large extent by what goes on in the US market. It accounts for I think it's probably about 70% of the value of global markets currently. So what happens in the US is really important. And if there is a big fall in the US market, it's true, it'll be very difficult for other markets not to be affected by that. But having said that, I do think after a long period of time in which US markets have outperformed other markets around the world and have become more expensive, as we've discussed, I think there is some merit in diversifying into other markets and benefiting from the lower valuations, and therefore I would suggest the slightly lower risk of investing in those markets. And I think that the UK falls into that category.
Yeah, and it wouldn't be a wholesale switch out of the US and into the UK. It would be sort of tweaking. What it occurred to me underpins this question is, you look at the last 2 years and the US market has done incredibly well. UK market's done okay, but the US market has done very, very well. And what you say is probably true, that if there was a crash in the terms of the question, a crash in the US market, probably something very bad has happened in the global economy and definitely in the US economy to make that happen. Probably not great for the UK market. But there can be circumstances where the UK market will outperform. Go back further than 2 years, but just 3 years to 2022, what we saw was the US market falling quite a long way, and the UK market didn't particularly rise, but it didn't fall those large amounts, did it? It kind of trod water for a year, and that's actually how you can get some outperformance from the UK.
Yes, and that might be a relevant parallel with the year ahead, because if we do see something of a rotation out of those quite expensive tech stocks into the broader market, and there's a question mark over that. But if we were to see that, then the sectoral makeup of the UK market is very different from the US market, and that's of course why it performed very differently in 2022 when the US market fell quite sharply and the UK market didn't. If there is a rotation into a different style of investing, the UK might do okay.
Okay, well, let's move on for now, Tom. The next question is this. And this, by the way, the theme of this question was the dominant theme of the questions this time. Lots and lots of questions on this same topic. How do you think, Tom, the global markets will react to a second Trump presidency?
Well, I mean, we've already seen how the markets have reacted to the prospect of a second Trump presidency, because, of course, we have this 2-month gap between the election at the beginning of November and the new president actually, moving back into the White House on the 20th of January. And the markets have responded very positively. And how they're responding is in anticipation of some of the policy measures which Donald Trump has already indicated, sort of tariffs on imported goods from other countries, tax cuts, deregulation, in particular, those three are particularly sort of pertinent for the stock market, and investors see a second Trump term as being broadly positive for business and for the stock market. Now, I think there are question marks about how it will actually pan out. We don't know what the tariffs will look like. We don't know, exactly who they'll be aimed at, although we can assume that China and Europe, parts of the European...
Maybe Canada, maybe Mexico.
Canada, Mexico. We've already seen, intimations of that since the election. So, we don't know what tariffs are going to be. We don't know whether he's going to manage to deliver the tax cuts that he talks about, because, the US government is heavily indebted. Can it afford tax cuts? We simply don't know.
Yeah, there's loads of question marks is the right phrase, isn't it? I mean, so first of all, looking at what we think we know he wants to do, tariffs, definitely he wants to do that. One of the maybe one of the only things he's been very consistent about across his sort of public life has been the issue of trade and tariffs. He's coming again. He said it before, but he's coming again, looking to impose tariffs. But he's also fought an election that he's won largely because Americans are sick of inflation. Tariffs, apparently, ask enough economists, they'll tell you, are inflationary. So we don't really know. Maybe they're wrong, maybe they won't be, but if they are inflationary, that could stay his hand. The American political system could stay his hand. There's plenty of opposition to what he wants to do, and plenty of ways for those opponents to stop him doing it.
The one thing that Trump does have in his favour this time around, which he didn't have last time around, is he has what's called a sweep, so that the Republicans now control the White House, the House of Representatives, and the Senate. Now, that's, you mentioned the checks and balances within the American political system, which might stay the hand of the president. The American system is almost expressly designed to make it difficult to push through these kinds of measures. So having a red sweep, Republicans in charge of all three branches of government, will make it easier for him to do that. But the inflationary point is a really good one, because he came in saying, I will get rid of inflation. Everything that he is likely to do is thought to be inflationary. It's probably going to be inflationary.
And they will, I take your point about the red sweep across the branches of government, but there will be people within his kind of Republican constituency that, for example, on the question of immigration, they'll be more willing to have open borders because of the economic benefits of that, whereas he's been very firm on wanting to close borders. So it's not as if he's got everyone on his side.
No, absolutely. And he has received very influential and important support from some of the big Silicon Valley sort of titans of the tech industry, and their politics and his politics are quite different in many ways, and it will be interesting to see how that pans out.
But just finally on this question, though, one thing we do know, this is said about Trump, that he sees the stock market and the US stock market as a bit of a barometer on his success, on political success in general. He will really want to keep the S&P 500 in a healthy state, won't he, through these 4 years?
Yeah, of course he would, and that's on all the tax cuts and that kind of thing is aimed at delivering that outcome. However, he does come into the White House for the second time after certainly 2 years of sharply rising markets, arguably after 15 or 16 years of generally rising markets since the financial crisis. Valuations are relatively high. And so there are tailwinds for the market in terms of his policy, in terms of earnings growth. There are reasons to think that the stock market might continue to move ahead, but it's going to be quite challenging for it to do so. And certainly those earnings are going to have to be delivered with valuations starting at the high level that they are.
Okay, well, let's move on for now, Tom. The next question. In 2025, what best constitutes a lower risk investment to shares in a classic 60-40 portfolio? given ongoing changes in the bond market in general and rapidly rising yields on UK gilts in particular. So I'm going to take this question to mean, Tom, what are the alternatives to bonds in a 60-40 portfolio? So the kind of counterpart to shares in that.
Yeah, and the context of this question is, of course, that traditionally people have achieved diversification in their portfolio by investing in a mixture of shares and bonds. And in recent years, it's worked well because bonds and shares have tended to respond differently to the same stimulus. So in the jargon, they are not correlated, they're uncorrelated. More recently, they've tended to move a bit closer together. And I think that the feeling is that the 60-40 portfolio, 60% shares, 40% bonds, may not work as well as it has done in recent years for that reason. So, if bond yields rise, which would be a negative for bond prices, so bonds go down, then probably shares will go down as well, because rising bond yields is not helpful for the stock market. So if shares and bonds move in the same direction, then they're not diversifying each other. So I think that investors probably will need to look a bit further afield for their diversification. Gold has performed very well and tends to be quite uncorrelated with shares. Property is another possibility. Infrastructure investments are another possibility. Even people are talking about, having a small proportion of maybe Bitcoin in a portfolio to provide some sort of diversification. I actually personally have my doubts about whether Bitcoin would be a good diversifier away from the stock market, because it feels like it moves in the same direction. It's a risk asset. But I think there is a strong case at the moment for quite wide diversification.
Which is not to say that you can't make a case for bonds in 2025, is there? Because rates are due to come down. Frame out for us, Tom, that situation, because that should be good for bond prices, shouldn't it? As rates come down, but it's how fast they come down versus expectations that kind of matter.
Yes, it's partly that. I think that, I'm not particularly positive on bonds at the moment, because yes, interest rates are due to come down over 2025, but I suspect by a bit less than we thought. So that is probably already priced in. The second element, which is important for bonds, is that bond yields are not simply determined by the level of interest rates. There's it's another bit of jargon, I'm afraid. It's called the term premium. And what that does is it's a compensation to investors for investing in a fixed income asset like a bond for a long period of time. Because as inflation eats into the value of your fixed income, you need to be compensated for that. And so at the moment, that term premium is very low, it's very small. People are not receiving much compensation for that risk. And it is beginning to widen. And so it's possible that interest rates could actually stay where they are, but bond yields could still go up. So I think for various reasons, I think that it feels to me like shares remain the asset class of choice rather than bonds. I think they do have an element of, a balancing element, a diversification element, but I don't think it's very strong at the moment.
Okay, well, let's move on for now, Tom. The next question, quite a specific one, or certainly about a specific investment. It is this. Back in 2020-21, I invested in Scottish Mortgage, not knowing it was then at its peak. Very quickly, it lost half its value. During the last few years, I've sat it out, waiting better times. It has risen, which is good, but I'm still in negative territory. Should I just hope for better days? Lots of people bought Scottish Mortgage. Lots of people did very well out of Scottish Mortgage. This questioner bought in right at the end of its good run.
Yes, well, as with all investments, but particularly so with this particular investment trust, Scottish Mortgage, timing was crucial, because the shares did spike higher in 2021. And then they fell very, very sharply, and then subsequently they have recovered, but they're nowhere near the peak that they reached during that period. So I think that this questioner has done the right thing by holding on, because it was a very dramatic fall from grace in 2022, and probably was overdone with the benefit of hindsight. So they've held on. That's good. Now, whether it is a good investment going forward
we don't know.
It's dependent on a lot of things. We don't know, and we also can't give advice to this particular individual. It's very focused on growth investments. It makes big bets on things which, if they do well, could do spectacularly well. And in the past, it's made some very impressive big bets. Amazon is a good example.
Yeah.
It bought Amazon, stuck with it, made a lot of money out of that investment. It has a lot of privately unquoted investments, which are quite hard to value and hard to know when that value will be realized. So it's definitely it's at the higher risk end of investments.
Yeah, and I think that's the point to make about this question. In terms of the case for holding on to it or not, I mean, it's up to you, but you just need to understand what you got on your hands with Scottish Mortgage, which is lots of growth. It's not just the Magnificent Seven tech stocks. It's some of them. You mentioned Amazon.
They're in there. Yeah.
Some of them are in there. This unquoted element has been very important because when sentiment turns against that, it can really harm an investment trust because no one knows what's inside and they become very nervous. One of the biggest holdings in Scottish Mortgage is SpaceX, the space exploration. Kind of a sector on its own almost. A space type company owned by Elon Musk, right? And not listed, so it doesn't have a valuation. Who knows what the value of that is? It might be worth huge amounts in the future, but you're going to have to hang on to find out. And you need to be aware that it could be a long time, very uncertain, but that's going to be the nature of that sort of investment.
Yeah, and Scottish Mortgage, of course, is an investment trust. And so therefore the value of its shares are related to the value of its underlying assets. But as you suggest, there is uncertainty about what the value of those assets is because they're unquoted. And therefore, one of the ways in which investment trusts deal with that uncertainty is that their share prices can trade at a discount to the book value, the stated book value of their assets. And in the case of Scottish Mortgage, that's true, as it is with most investment trusts, but they're trading at about a 12% discount currently. Suffering
from some of the issues that have affected all sorts of investment trusts. We've got another question coming up on that, Tom, so I'm going to leave that there for now. But yeah, hopefully some of that has been useful for that question. We're going to move on, Tom. The next question is this. If I were to invest in actual FTSE 100 index stocks, I would receive the dividend payout. But if I invest in an index tracker, I do not receive any benefit from dividends paid. Have I missed something? Is this not misleading?
I think the questioner probably has missed something, which is that a tracker fund, just like any other fund, has different share classes, some of which are designed to pay out the income that they receive, and some of them are designed to reinvest the income in the value of the fund. And so you do get as an investor in a tracker fund, you do get the benefit of the dividends. It's either reinvested on your behalf and rolled up in the value of the fund, or it's paid out to you, and it's your choice depending on the share class that you choose.
Exactly, and so those two different share classes will have a different, their performance of the unit prices will be quite different. And I looked actually, this was before the turn of the year, admittedly, but I think the FTSE 100 did something like 11% once you included dividends last year. You take those dividends away, the index was about 7% up. But of course, those dividends would have been paid out as well. So probably you are benefiting from the dividends.
Yeah, well, either way you benefit.
Well, you
either get it up, either get it in your hand, or it's rolled up in your investment. Yeah.
Okay, short and sweet. Let's move on. Okay, the next question, Tom. Given likely volatility in 2025, what is the best way for those closer to retirement to de-risk their portfolio while still keeping pace with inflation?
Okay, well, I mean, we've mentioned a few of the sort of de-risking strategies, and one of which is diversification, because clearly markets around the world are valued in very different ways. Some are much cheaper than others, and they will therefore perform in different ways. It's not necessarily the case that the cheaper markets will do better than the more expensive markets, as we've seen with the US. It's continued to appreciate faster than other markets. So I think diversification is one way of doing it. The part of the question is about beating inflation, which I think is an important point to make, because actually it's actually easier to keep pace with inflation now than it has been for a long time, partly because inflation is much more manageable. Cash is actually, you can earn 4 or 5% on a cash fund now, and that is more than in inflation. In most places that we track.
So inflation is 2.6, 2.7.
The last reading for inflation in the UK in December for November was 2.6%.
And you would have got about 4 or 5% on cash in that time.
So. You would. So you are getting a real inflation-adjusted return just from cash. So that is a pretty sensible. If you're wanting to de-risk, there's no safer asset than cash. And if you can get a real interest rate, an inflation-adjusted interest rate on your cash, then that's probably a good first port of call.
Yeah, and I'll just extend. I mean, the question hasn't asked this, but a sort of tangential point here is around how you organise your finances going into retirement. It sounds like this person's ahead, not yet retired, but getting closer to it. How are they going to use that money? Is it going to be to buy an annuity? That's also a way actually to de-risk, isn't it? Or are they going to be exposed to investment growth whilst also taking an income, in which case they might want to have a proportion that is just generating income or just held in cash that they can spend while still being exposed to more kind of volatile assets.
And that does raise an important point about preparation for inflation. For retirement necessitates thinking about inflation, because if your retirement's going to be over 20 or 30 years, inflation could be a very significant factor over that period of time. In which case, what I've just said about cash, yes, it's giving you a real inflation-adjusted return now, but that may not be the case over that 20-year period. And so,
and it hasn't historically been with cash. Okay. All right, let's move on. Related, I guess, are annuities worth purchasing at present? And are rates on annuities likely to fall? So,
annuity rates have improved very significantly as interest rates have risen. So, if you I did actually have a look at annuity rates in anticipation of that question, and they are for a 65-year-old man, flat rate, no inflation adjustment, nothing for a partner. Just the pure vanilla annuity rate at the moment is about 7.5%. So £100,000 will give you £7,500 of income at the moment. Now, that's pretty high historically. I mean, if you go back to 2008, before the financial crisis, before interest rates fell down, close to zero, I think the peak that they got to then was 7.9% in 2008. So they're on a par with what they were then. So pretty attractive. Now, if interest rates come down materially from here, then obviously annuity rates will fall in line with that. But annuity rates are determined by bond yields. And, we talked about the reasons why bond yields don't necessarily move exactly in line with interest rates. So, yes, annuity rates may come down from here, but, they may not come down that much.
It's a good question, because there's two sides to look at it. Rates on annuities are very good. You don't even need to go back to 2008. I mean, in 2021, say, rates were at historic lows at that point. And I don't know what they are. I think about 50 to 60% higher, depending on exactly the nature of
they were down at about 4 point something back at the low point.
So significantly better. And we think rates are going to come down. Now, they might not go back to that level. And I take your point about rates not being exactly translating into annuity rates. But it could be a good reason to buy annuities for that reason. However, there are good reasons to wait until you annuitise, because your age is a factor in the price that you get. Your health is a factor in the price that you get. Your rate is likely to get better the older you are. So you've got to look at that as well.
I think that the timing of when you choose to buy an annuity, if you choose to buy an annuity, is pretty complicated for all the reasons that you say. There are lots of moving parts: age, health, interest rates. Probably something that you might want to get some advice on.
Maybe, and also just what personally do you want your income to look like? Some people will just say, I like the security of knowing I'm going to get this forever. Some people will say, well, I want more now, less later. All these things are going to affect the decision you make.
And just from a sort of personal, anecdotal point of view, I mean, I'm not particularly interested in buying an annuity now, in my early 60s, but in my mid to late 70s, I think that I may well be quite interested in at least annuitizing part of my income.
Yeah.
So, because I think the issue for all of us now is, we have to take responsibility for managing our money through our retirement. That's a big change. For my parents' generation, they've never had to think about that. They just got a final salary pension. They didn't have to think about it. We are going to have to think about it. And while I don't mind thinking about it when I'm 61, when I'm 78, I might think very differently about it. And I might, at the very least, want to just cover my basic expenses with an annuity.
Okay. The next question, Tom, is this. I was thinking of taking £20,000 out of my pension pot and investing in an ISA. I have already taken the 25% tax-free cash. Would this be a bad move?
Well, I mean, so both a pension and an ISA have some tax benefits, some tax advantages. I mean, the questioner says that they have already taken their tax-free element. So you have to assume that any money that they take out of their pension is going to attract income tax on the way out. So that's definitely a consideration, whether they want to do that. So I think to take the money out of a pension and put it anywhere other than in another tax-advantaged wrapper probably doesn't sound like a good idea. But it may make sense to put it in an ISA.
Yeah, it could be sort of net out neutrally because they as you say, your capital gains are tax-free inside a pension and an ISA, so no kind of difference there. Let's assume they're going to be invested in the same things within both. A couple of things to say though, because if you leave money inside a pension, there is the potential that your tax rate lowers in the future. Yep. If you pull it out now and you're, say, a 40% taxpayer, but in 10 years' time you're going to be a 20% taxpayer, then it would have been worth waiting and keeping it in there versus taking it out and putting it in an ISA.
Yes, and then there are other tax considerations as well. There's the inheritance tax. Rate considered, and obviously there have been changes to the inheritance tax treatment of pensions in the most recent budget. They haven't taken effect yet, but they will do in due course, unless something changes. So that's also needs bearing in mind as well. Yeah,
so it depends is the answer. Basically, we don't know.
Answer, as ever.
Okay. Let's move on, Tom. Okay. The penultimate question, actually, 2024, the questioner says, has been notable for the large valuation gaps that have emerged between NAVs and traded prices on investment trusts. We're going to explain these terms. With even some leading trusts trading at discounts of over 10%. Should individual investors be concerned by this? So probably need a bit of background as well as some of the technical explanation.
Yes, I mean, I think we've slightly touched on this when we were discussing Scottish Mortgage, but I mean, what this question is referring to is the gap that can and does open up between the value of an investment trust assets and the value of the investment trust, i.e., the value of its share price times the number of shares. So they move separately. They're related, of course. But depending on a number of factors, one of which might be the confidence that investors have in the valuation that's being put on the assets, the share price might trade at a lower level than the assets. If there's great confidence that the value of those assets is going to rise, then occasionally it's the case that the share price of the investment trust is actually higher than the value of the assets. That's called trading at a premium as opposed to trading at a discount. So that's the mechanics of it. They move separately. Now, for some time, investment trusts have traded at quite a significant discount to the value of their assets, and there are a number of reasons for that. One of which is the fact that they are UK quoted investments.
The UK shares, basically.
They're UK shares, essentially, and the UK stock market has been pretty out of favour, as we discussed in a previous question. So that's one of the reasons. There are also some sort of more technical reasons around the sort of sectors which investment trusts tend to be invested in. So a lot of them are invested in infrastructure. A lot of these trusts were launched at a time of very low interest rates when investors were looking for income. And they were prepared to pay a premium to get that income. And then as interest rates rose, the mechanics changed, the equation changed, and they moved to a discount. So again, there are a lot of moving parts when it comes to discounts and premiums with regard to investment trusts.
And it's difficult to predict when they're going to recover, or will they ever recover. I spoke with our investment trust sort of expert on the team, Richard Evans, before the conversation we're having today. And he sort of laid out some of the reasons why UK investment trusts have been suffering. The general malaise of the UK market is definitely a factor in that. Also, some of these are quite small in size, and very large institutional investors that might want to buy their shares are themselves so big because of consolidation in the fund management industry. They're so big that actually it's not worth their while to invest in such a small investment trust anymore. So they're losing a kind of institutional audience for what they do. So there's fewer buyers out there. We should also mention a technical thing that's going on in the investment trust space at the moment, where activist investors are coming in and they're saying, well, look, you've got these assets. The actual price I can pay is hugely discounted in the way that you described, Tom. So I'm going to come in, I'm going to do all sorts of things that drive up that discount or evaporate away the discount. And that can actually be quite good for anybody holding those shares, can't it? Because they can see a sudden increase.
Absolutely. And we've had a good example of that actually within our Select 50 list. So we had a property, a real estate investment trust called the Balanced Commercial Property Trust, and it traded at a discount. There was the board sat down and thought about what can we do to narrow this, and they ended up agreeing a bid from another buyer who came in and bought their assets at a much smaller discount than the shares were trading at in the market. So that was good news for the holders of those assets.
And it's really hard to make blanket statements here, but if you're holding shares in an investment trust, it's a worry that you've seen that discount widen. If it just widens and widens and widens, maybe you end up in a situation like that. So
it can be an opportunity.
And the boards of investment trusts have an interest in closing that discount, don't they? And they often have plans to do it.
Yes, and that is their role. I mean, they have an obligation to look after the interests of shareholders, and part of that is ensuring that the discount narrows to a more manageable level.
Yeah, because investment trusts are very popular with some small investors, aren't they? Because there's all sorts of built-in protections. The boards are part of that. But it's been a tough time, isn't it, waiting for these discounts to narrow?
Yeah, I mean, the discounts have fluctuated quite a lot. So, when they've widened, that's been a worry, as the questioner points out. But it also does create an opportunity when they narrow.
Okay, all right. The final question today, Tom. Actually, you've touched on this, but let's get into it a bit more. Labour, Tom, will change the IHT rules around pensions, as you have to wait to a ripe old age to get 75% and then potentially lose 40% IHT when you die. I'm not sure they've got that right, but we'll explain it. Is investing in a pension not as tax efficient as it once was? Basically, this change that's coming down the line with IHT, where from 2027, pensions are suddenly going to be counted inside your estate for IHT purposes. Does that make pensions inefficient now?
Well, I mean, on the face of it, it makes saving into a pension less attractive from one perspective. It makes it less attractive for your heirs and your beneficiaries. It doesn't actually make pension saving any less attractive as a mechanism for saving for your retirement. And let's not forget that is the aim of pensions. Now, in recent years, they have been used as a tax planning measure, because pensions sat outside your estate from an inheritance tax perspective, and people not unreasonably realised that that was a sensible way of managing their affairs in retirement in order to pass money on to the next generation. So I'm not surprised that the government had a go at that. A lot of the tax benefits for pension saving are very significant. They're a big cost for the government, so I'm not surprised they went after it. I think you have to think about pension saving more in the round, though. Pension saving is still an attractive way of managing your financial affairs. If you're in a company, for example, you're likely to get contributions from your employer, matching contributions. That's a very tangible benefit. So I think there are good reasons to still be investing in a pension, even though at the margin they are less attractive than they were before the budget.
Yeah, I think the question, I guess, is for people already with that money in a pension, what do they do? And they've got an expected IHT liability in the future, or their state will have. What do they do? Because what the question was getting at, I mangled the question slightly, but what they were getting at was that under the current system, if you die before age 75, the money in a pension can get passed to a beneficiary without any income tax or IHT.
Yeah.
After 2027, April 2027, that will change. So IHT will apply. And if you die after age 75, income tax is going to apply on it. And you can get to these very, very high marginal rates of tax.
Yeah, you get what looks like a double taxation.
Yes.
Yeah.
Which is not perhaps completely fair, because that money is always going to be taxed, isn't it? Well, I suppose unless death happens before age 75. But
well, it's not completely fair, because you've had tax relief on the way in with your contributions.
Yes.
And every other asset that you own is liable for inheritance tax. So all it does is actually aligns your pension assets with all your other assets. Now, if you've saved into a pension on the basis that is not the case, that actually there's a favourable treatment, then it's not unreasonable that you might say, well, you've changed you've moved the goalposts.
Yeah,
here,
that's right.
Which is true. So, I mean, rather unhelpfully, you can argue it from both
you
sides.
can, and it's probably going to take, people with significant liabilities to IHT, it's probably going to be worth them getting some professional help here. Proper estate planning, because there's all sorts of ways to actually mitigate IHT, and you can pass on very, very large sums without any IHT applying at all.
Yeah.
But what this change will do, I think, will put more focus on those occasions where that's not possible for various reasons, because of circumstances. And you will see an increase in the amounts being taken in IHT and the number and the types of people exposed to it.
Yeah, and the numbers involved are very significant for many people. We're talking about big sums of money. So getting some advice is going to pay for itself very quickly.
Well, Tom, thank you. That is all the time we have now for questions. Thanks to Tom for joining us today to answer them. If you asked a question that we didn't get around to answering, we have a special edition of the Personal Investor Podcast, which will answer yet more of those questions. You can listen to that on iTunes or wherever you usually get your podcasts, including actually YouTube these days. A full copy of Tom's Investment Outlook is available to download at fidelity.co.uk/outlook. Thank you so much for watching, and do join us again next time. Bye for now.